What are some quality stocks to own? Today we'll speak with a top investor about 12 stocks he likes, plus he'll explain his 3 secret steps towards building a perfect portfolio. So let's get started. This is Ticker Take. You know, we talk a lot about growth stocks on Ticker Take, but they don't always meet all the needs for you as an investor. So we wanted to talk with one of our favorite guests, Lyle Stein. He's been investing for more than 3 decades, and while he invests in growth stocks, he also thinks about how to round out your investment portfolio. Let's hear more from Lyle now. Lyle Stein, great to see you. Thanks for joining us on Ticker Take.
Nice to see you, John.
So this is an interesting time for the market. Most would still describe this as a bull market, but there seems to be a little uncertainty in the air. What's your take?
Yeah, this is a tough market to call. I think you're right. The momentum is there. That's positive. The economy is doing just fine, despite the fact that we've had tariffs, despite the fact that the wars that we've been talking about now are going into, 4 years in the case of the Ukraine and Russia. Yet there's just a sense of angst out there, where we keep talking about the K-shaped economy, the notion that it's the rich, the wealthy that are doing very, very well, but those who aren't wealthy, those that don't have assets, are hurting. There's concerns about young people and their jobs. So it's a mixed bag that seems to be coming through. And so as a market analyst, after going through now 3 years of a really strong market, you're asking what's in store. And we're a little bit cautious going into 2026. We think that, basically fundamentally driven earnings and interest rates are what happens to drive market stocks. Interest rates can't seem to crack 4%, and I'm talking that long-term U.S. Treasury bond. It just doesn't want to go below 4, and there's fears about potential inflation as companies raise the prices that we all thought would happen in 2025, as governments around the world continue to borrow. So it's going to be hard to see rates falling. And then earnings. Well, earnings growth is good, but it's already been good. It's been really good. It's been anticipating 10, 12% growth for 2026 for going on over 12 months now. And there's just no room for an accident. So when we look forward, we think it's more of a market to pick stocks in, to stay with themes, than it is to try to call the market in general.
All right. Well, that's interesting. Kind of like a bifurcated economy you're referencing there. And we're going to talk about some individual stocks, and we're going to get specifically into a basket of stocks that you might suggest in an economy like this. But in building that basket, you really are passionate about the concept of the 3 C's. One being comfort, so income. One being calamity, and gold might be an example there. Sure. And children. So legacy, but in other words, growth that you can pass on, I assume, down the road. So the 3 C's, how do you think about investing through that lens?
Well, the key thing is it's a total portfolio. Too often, I think investors want to focus on the hot name or the hot sector. Like, I want to go out there and I'm going to make money because it's going up. But basically, if you're a long-term investor looking to preserve and grow wealth, you have to think in terms of the total portfolio. And in a total portfolio, you're never going to get the performance that you get from the one hot stock or the one hot sector. So when we construct portfolios, we like to, first of all, ask the client, what do you want? What do you need? Comfort, you mentioned the first one. That's really income. Do you need income from your portfolio as an investor? Okay, we can generate income. In today's market, we think we can get 5.5% in income for a client. The next thing, if you have income, though, is, well, I get nervous about my income. So we protect that as best as we can. We call that calamity. That's the second C. How do you protect that income stream from basically inflation and geopolitical concerns? And that is an important thing that we've seen over the course of the last couple of years as we've gone through an inflationary run-up, now more of a disinflationary environment, but inflation is still 3%. And then the last one, as you say, is if you got your income and you feel comfortable with respect to the way it's protected, well, then it's growth. Then it's charity or children. You can swap the C's around. But basically, that's your legacy. That's where you can put investments that you think will do well over the course of the next 10 to 20 years. And think about it, not in the context of, 20 years from now, but what am I going to leave to my legacy? And so that 3 C's, you construct a unique portfolio because, frankly, every client is different.
All right, great context there, and we're going to get into Lyle's list of stocks now, but first, a friendly reminder, this is not financial advice. Stock number one, Alphabet. Now, Lyle, Alphabet, the parent of Google, we talk a lot about this company. In fact, we did a full ticker take video on it recently. But what stands out? How does this fit into the basket?
Well, when you look at Alphabet today, we see it in terms of three distinct areas. But from a market perspective, first of all, the thing that really attracts us to the stock is it has a more defensive nature to it. It's got good revenues today. There's a lot of AI related stocks that we're waiting for revenues to come. Alphabet's got it through their advertising business, through all the other things they're doing. So then when you break it down, they've got their TPU chips, and those are quite exciting to us because the world going forward is going to be less about compute and more about inference, and that's where the TPU chip comes in. So tick number one. Number two, their Gemini AI program seems to be dominating. It seems to be taking share away considerably from ChatGPT. So that's number two. And then number three, it generates free cash. And there's nothing wrong with free cash. They're able to invest in their spending for AI and growth from the cash they're already generating. And that came to some degree, too, from the fact that the antitrust suit seems to be resolved in September. So we've acquired it more recently, but it seems to be the perfect name for this kind of environment.
Stock number two, Amazon, which, Lyle's another name we've talked a lot about a ticker take. When you look at the analysts on Wall Street, they have loved this company for a long time. Like Alphabet, this fits into that children or legacy growth part of your basket of stocks. Walk us through Amazon.
Yeah, exactly. And you've nailed it. Now, it's been a laggard this year. Amazon has not performed in line with the names that you think of in an AI run. But to us, again, it's the stable cash flows that are coming from their retail business. And their retail business, frankly, is cheaper than Costco when you look at it on a kind of a multiple basis. Their web services, great business. It's a revenue generator. They have their own data centers right now. They don't need to necessarily build them. And again, it just generates lots and lots of cash. They don't have to go out and borrow the way many in the AI space are doing. You think Oracle and all the problems they're having right now. The stable cash in an uncertain market gives us a good place of comfort. And, it trades at 20, 25 times kind of 2-year out earnings. And we're looking at 2-year out earnings as opposed to what's going to happen in 26 because we like to take a longer term view.
Stock number three, Sienna Senior Living, which gets us into thematically. I know you like certain long-term trends to be watching. Aging demographic is a big one.
It is. And we really see Sienna is ticking two boxes. Number one, for that comfort, it's got a 4.6% yield. We think that yield is very safe, and we think it will continue to grow. So that's a really important thing. In a demographic shift that's occurring, John, we just don't have enough houses for people like me when I start to age. And so where are those retirement homes going to come from? Where are the care facilities going to come from? We're 48,000 beds short in Ontario alone. And that number is only going to get bigger. So when we look at the space, we see Sienna as a particular good way to play the aging theme, which is part of our growth investing scenario that we talked about earlier.
Stock number four, Peyto. And now we're going to get into a group of stocks that are part of an energy transition, if you will, which you're watching very closely as a theme.
Yeah, back, again, 3-4 years ago, the energy transition was going to be to wind and solar. And we struggled with that concept because, number one, there was a lot of capital being required. But number two, the ability to get from here to there just didn't make any sense. We couldn't get all the grid built and we couldn't get all this done. So that was the theme. We said, okay, what are the names to play? And Peyto came to mind. Now, we bought Peyto, again, probably 3 years ago. It had a 14% yield. It's in natural gas space. Natural gas to us is the transition. We got the theme going on transition, and we also got a 14% yield. It wasn't the favorite of the day, but it was cheap. And gas is playing out. The concern was their balance sheet. They've improved the balance sheet over the course of these last 3 years, and it still yields just a little bit south of 5%. So we get income as well as growth, and that's the holy grail in building a portfolio.
Stock number five, Tourmaline. And so we stay on the same theme with this one that we were talking about with Peyto.
Yeah, it's the natural gas theme, and Tourmaline is the big go-to gas name in Canada. We look at a company that's got very good reserves up in the Montney. we look at a company that pays a decent dividend, but they pay extra dividends to make the total return better. It hasn't performed well, and I think that's just a concern in natural gas in general. So we like the fact that it's a low-cost producer, it's growing its reserves, and also it's the name people think of. And when you look at the Canadian energy patch today, Tourmaline is a big cap name, and we've been overlooked when it comes as a country. The old story again, 3-4 years ago, I don't want to own a gas stock, I don't want a Canadian stock. All our energy investments suffered under that realm, and I think you can get a bit of a multiple pickup as well on a Tourmaline as it comes into favor with more and more gas demand.
Stock number 6, Vermilion Energy. So we're still on this energy theme here. How does this one compare to, say, a Tourmaline or a Peyto?
This one has been a very poor performer. We've held it. We've held it actually through the beginning of the Ukrainian war when gas prices rocketed up in Europe. Vermilion produces lots of natural gas in Europe for the domestic market. They've got fields in Germany, fields in the former FSU type countries. They're growing. That is exciting. But they've made an acquisition. The market didn't like the fact that they made an acquisition, and the stock has really been a laggard. In a portfolio, you have to have a little bit of risk. And so we look at this one as kind of the way we looked at Peyto 3 or 4 years ago when it was perceived to be, debt, or in this case, acquisition. These guys over the years, and I've followed this company for, more than a decade, they've been great allocators of capital. And we see that taking place. Again, a re-rating on the stock, as well as continued increases in gas prices will play Vermilion very, very well.
Stock number 7, TC Pipelines. Now, we're still in the energy transition story here, but getting a little bit more into the pipeline area.
Yeah, and think about energy transition. We've got all this gas up in Alberta, and the markets are all on the East Coast or on the Gulf Coast. You got to move the gas. So who's going to move the gas? TransCanada. It's almost that simple. It's got good growth as they continue to ship gas to data centers on the East Coast, to the LNG facilities and the Gulf Coast. But more importantly, good discipline. They raise their dividends, 2, 3, 4% a year. That's outstanding, and it pays a nice yield. It's not the yield that it was, but you're still getting a 4% yield. And in this environment that we talked about, the uncertainty in the market, a 4.5% yield looks really, really good because it's the bird in the hand. You don't have to bet on something happening 2, 3, 4, 5 years down the road. So to us, it's just a great kind of stock you want to hold.
Stock number 8, Enbridge, staying with the pipeline theme, a company that is a juggernaut really in North America.
It is. It's gas and oil. It moves, again, all the hydrocarbons from the Western Canadian Basin into the biggest market in the world, which is the U.S. It's a company that, again, has got a great capital discipline. It increases its dividend, albeit slightly, and now it's yielding, 5.5, close to 6%. Again, I get my return up front. This company has been a phenomenal investment since they built the first pipelines in the 50s, and it really continues to perform well. Now, is it hot? No, it doesn't go up and down with technology. But again, it's that safe, stable, nice yield with a little bit of growth, 5.5% dividend, 2.5% growth. That's 8% total return, which to us is the long-term return on equity. So Enbridge is a great way to play it with a little bit more comfort at the front end.
Stock number 9, Cameco, which gets us into, I suppose, another part of the energy transition. A lot of people have been talking about the nuclear opportunity.
Exactly.
Yeah.
So the transition, again, go back 5 years ago, everybody was talking about solar and wind. Well, natural gas is the transition ultimately to nuclear. And so when you look at Cameco, historically it has been a provider of uranium, the basic material. But what really turned us on to the Cameco story not too long ago, 2 years ago, a year and a half ago, was the acquisition of Westinghouse. Cameco and Brookfield each took a 50% interest in the bankrupt Westinghouse, and they got a gold mine of an asset. This, you always want to own the arms dealers in any kind of investing. This is the arms dealer to the nuclear business. And, Trump announced, about a month and a half ago, we're going to build 10 new reactors. Westinghouse wins. It's to us just a perfect way to play the ultimate end game, which is more nuclear power, generating the electricity we need to fund the future economy.
Stock number 10, Agnico Eagle Mines. So this is a big gold player, and gold has been a massive theme over the last year plus. And you talked about that C for calamity and how gold fits in. So walk us through the Agnico story.
Sure. Well, you got to start with Forvest. We are a Swiss company, and so by default, have Swiss ownership, we have to have a percentage of the portfolio in gold. So put that aside. 5% was a rule. I remember the old CEO of Nesbitt Thompson, when I was there, had a rule: have 5% of your portfolio in gold and hope it goes to zero, because everything else is going up.
Right.
Well, this is calamity. When you want to protect against calamity, you need a quality gold producer, and Agnico ticked all the boxes. It's a low-cost producer. It's got good growth and a well-defined growth plan, which is typical of all good businesses. Management has been first rate. I've followed this company for more years than I'd like to think, and they always do a good job of delivering on what they're promising. And so when we look at a company like Agnico that can produce gold at an all-in sales cost of around $1,000, and you see gold at roughly 4,000 plus, there's a lot of margin in there that generates cash that is now going to be returned to shareholders because they pretty much paid off all their debt. It's a great quality name to own. It's been the go-to name in the gold sector now for the last 5 years.
Stock number 11, Franco-Nevada. So we're staying on a metals theme here.
We are. And Franco-Nevada is a metals play. It's a streamer. So it participates in the uptick in gold prices through the fact that they get a certain percent of the revenues that are coming out of the gold production at mines here, there, and everywhere. So it's a play on gold directly. But they also have this play on First Quantum Minerals, which has been going through all kinds of issues in Panama. Stock had quite a downdraft when the Panamanian government basically shut down First Quantum. Right. First Quantum is now opening. Copper prices are now over $5. And so we've got in the Franco story a little bit more of an uptake from not just precious metals, but basic materials. And copper being, again, the long-term play to get into the grid, and a new mine, one of the largest mines in the world that's now in effect opening up. They'll participate in that. And we see that as providing good tailwind into 26 and 27.
And stock number 12, Sprott, staying on this metals theme, a firm that has in a lot of ways been all in on metals over its existence. But walk us through the Sprott story.
The Sprott story is started with gold, right? They have a gold fund. They have gold investment funds, but they also have a silver fund. And the run-up that we've seen in silver prices has done a phenomenal job because they're asset managers. If you have a silver fund, an ETF, and the value of silver goes up by 100%, the value of your ETF, everything else being equal, goes up by 100%. You get a management fee now on that 100% increase. We like the fact that it's kind of an indirect play on the precious metals, but they also have uranium. They have a uranium fund, and they've been out there purchasing uranium, not at current prices, but prices under $40 at some point, not too far long ago. So they are a bet on the materials as well as on the precious metals, and they're disciplined. And we just think it's a great way to play not just gold, not just silver, but uranium all in one. So we get three, we think, good long-term commodities all under one roof.
Great to get this basket of stocks perspective from you. Lyle, thank you so much for joining us today. We appreciate it.
John, it's been great. It's always enjoyable to talk to you.
All right. Our thanks to Lyle Stein for sharing those stocks. You can learn more about Lyle in our description, where we've got all sorts of ways to connect with us on Ticker Take, from our podcast to our free investing newsletter. And don't forget to subscribe so you don't miss our next investing video. See you next time.